The greatest fortunes in trading are rarely lost because of poor stock selection. They are destroyed by undisciplined capital commitment. Most traders mistakenly define position sizing as a static percentage risk calculated before the trade even begins. They decide they will risk 1% of their account, then immediately deploy their full intended size at the initial entry point. This exposes their maximum capital to the greatest risk, the risk of unproven timing. Jesse Livermore, the legendary speculator, understood that true position sizing is a strategic mechanism for managing timing and confirmation, not just a simple mathematical calculation. Livermore's mastery of capital deployment was the true secret behind his ability to amass and protect millions of dollars across multiple market cycles. He recognized that the initial entry is almost always the most uncertain moment of any trade. Therefore, committing maximum capital at that moment is fundamentally reckless, even if the underlying thesis is eventually proven correct. Livermore's secret rule dictates that the maximum commitment of capital is only deployed after. The market itself provides undeniable confirmation that the initial analysis was correct. This patience in scaling is the bedrock of his long-term success and capital preservation. The common retail trader often suffers from a psychological impulse to immediately capture the full potential profit. They fear missing the move and rush to put their entire allotted size on the line immediately. This impatience transforms position sizing from a protective tool into a liability, making the trader vulnerable to stop-loss hunting or minor market noise. Livermore's methodology forces the trader to slow down, to test the waters, and to let the market prove its readiness before risking substantial wealth. It is a discipline of delayed gratification, ensuring that large risks are taken only when the probability of success has demonstrably increased. This strategic approach fundamentally changes the nature of risk management. Instead of focusing solely on the distance to the stop-loss, Livermore focused on the quality of the entry timing. If the timing was poor, even a correct long-term thesis could lead to a large, unnecessary drawdown or early stop-out. By delaying full commitment, he protected his capital from the inevitable errors in predicting the exact moment a major move would begin. This method provides a systematic defense against the emotional urge to gamble on an unconfirmed price movement. The mandatory initial step in Livermore's process is the establishment of the test position, often referred to as the probing entry. This initial trade is deliberately small, typically representing only 20 to 25% of the total intended position size. This fraction is not meant to generate significant profit. Its sole purpose is to act as a reconnaissance unit. The small position is deployed to gauge the immediate reaction of the market and confirm that the line of least resistance is indeed in the anticipated direction. This initial probe is the foundation upon which all subsequent capital commitments are built. The primary function of this test position is to confirm the entry timing. If the price immediately moves favorably, it confirms the trader has entered at a moment of low supply or high demand, validating the immediate timing. If the price immediately moves unfavorably, it signals that the market is not ready, regardless of how strong the long-term analysis might be. The test position acts as a low-cost filter for timing errors, which are the most frequent cause of premature trade failures. It is a critical psychological tool that separates speculative gambling from disciplined capital management. The immediate action rule governing the test position is non-negotiable and absolute. If the pilot position shows an immediate loss, the entire position must be liquidated instantly. This liquidation occurs even if the loss is minor and the trader believes the price will eventually recover. The immediate loss confirms that the timing was wrong, and the market is not yet prepared to move as expected. Taking this small, swift loss is the highest form of capital protection, saving the trader from sitting through a potentially large, unnecessary drawdown while waiting for the thesis to validate. This discipline prevents the fatal error of immediately committing maximum capital to a trade that is already showing weakness. A trader who commits their full size immediately and then sees a small loss is psychologically pressured to hold on, hoping for a reversal. Livermore avoided this emotional trap entirely by defining the initial loss on the pilot position as an unequivocal signal to retreat. He understood that a small loss taken quickly is merely the cost of gathering accurate information about the market's immediate intent. The willingness to accept this small loss preserves the majority of the capital for a better, more confirmed entry later. Consider a trader intending to buy 10,000 shares of a stock-breaking resistance. Instead of buying all 10,000 shares at the breakout price, Livermore would buy 2,000 or 2,500 shares. If the price immediately retreats below the breakout level, those 2,500 shares are sold immediately for a negligible loss. This action confirms that the breakout was false or premature, protecting the capital that would have been committed to the remaining 7,500 shares. This quick exit preserves the trading ammunition for the next confirmed signal, rather than tying it up in a struggling position. The power of this initial small position lies in its psychological insulation. Since the risk exposure is minimal, the trader can observe the market's reaction without the paralyzing fear associated with maximum exposure. This allows for objective decision-making based purely on price action, rather than being clouded by the desperation to protect a large, prematurely deployed stake. The test position is the trader's reconnaissance, designed to gather intelligence before the main force is deployed. It is a calculated expense for market information. Many novice traders view the test position as inefficient, believing they are leaving money on the table by not committing fully. However, Livermore recognized that efficiency in capital deployment is measured by survival and consistency, not by maximizing profit on a single trade. The occasional small missed gain is a tiny price to pay for the massive protection against catastrophic timing errors. The goal is to survive long enough to capitalize on the confirmed large moves, and the test position ensures this longevity. This systematic approach mitigates the common problem of getting stopped out only to see the stock fly. When a full position is stopped out early, the loss is significant and damaging. When only the pilot position is stopped out, the loss is negligible, and the trader retains the flexibility to re-enter when the confirmation finally arrives. It is a patient strategy that prioritizes capital preservation over speculative haste. The entire philosophy is built on the premise that capital protection is the first and most important job of the speculator. The second phase of Livermore's position sizing strategy begins only if the initial pilot position shows an immediate and sustained profit. This is the crucial requirement for scaling up the trade. Profit confirms that the initial analysis of the line of least resistance was correct, and perhaps more importantly, that the entry timing was precise. Without this immediate confirmation of profit, the trade remains in phase one, and no further capital is committed. This requirement enshrines the anti-martingale principle at the heart of his strategy. Livermore never bought or sold more of a security that was moving against him. This rule is a fundamental divergence from the disastrous practice of averaging down, a habit that destroys more amateur accounts than any other single factor. Averaging down is a desperate attempt to reduce the average cost of a losing position, which only increases the total exposure to a trade already proven wrong by the market. Livermore strictly reserved position size increases for trades that were already demonstrably winning. A winning trade validates the thesis and the timing, making subsequent additions inherently less risky than the initial entry. When a trader adds to a winning position, they are placing capital in an environment where the market is already moving favorably, indicating institutional support and momentum. Conversely, adding to a losing position is betting against the current flow of the market, which is a low-probability, high-risk endeavor. Livermore understood that compounding success is the path to wealth, not compounding failure. The disciplined scaling method Livermore employed can be conceptualized as a three-step pyramiding structure, often following the rule of thirds or quarters. This structure ensures that risk is systematically reduced as the position grows. The second tranche of capital deployment is the first major commitment after the test position. This next portion, perhaps 25 to 30% of the total size, is added only after the price has moved significantly past the initial entry point. The definition of significantly past is crucial here. It means the initial position has already secured a paper profit large enough to cover the potential stop loss of the entire first tranche. This shift ensures that the second tranche is added from a position of strength, protected by the existing gain. The goal is to move the break-even point of the combined position substantially higher than the initial entry, but only after the market has cleared minor hurdles. This systematic process minimizes the risk of a full-size loss. This second addition must be accompanied by a clear shift in market structure, such as clearing a minor resistance level or holding a key short-term moving average. The market must be confirming the momentum, not merely consolidating after the initial entry. If the market shows hesitation or choppy movement after the first tranche, the trader holds the line, waiting for undeniable confirmation before committing more capital. Patience remains the dominant virtue throughout this scaling phase. The third and final tranche represents the largest commitment of capital, often 50% of the total intended position size. This final deployment is triggered only when the market has confirmed the major move, such as breaking a critical long-term resistance level or definitively moving into a new trend phase. This is the moment when the trade transitions from a promising setup to a fully validated market movement. By this point, the initial two tranches should have substantial paper profits. Deploying the final, largest portion only at the point of maximum confirmation provides the ultimate safeguard. The initial gains act as a substantial buffer, meaning that a sudden reversal would first erode the paper profit before touching the initial capital commitment. This structure ensures that the majority of the risk capital is deployed only when the probability of a major, sustained move is at its highest. It is a testament to the discipline of waiting for overwhelming evidence. The psychological benefit of this pyramiding is immense. By adding to a winning position, the trader reinforces positive habits and builds confidence. Each successful scale-up validates the underlying analysis and the timing strategy. Conversely, the trader avoids the negative reinforcement loop of constantly pouring good money after bad, which is the hallmark of averaging down. Livermore's method creates a positive feedback loop. Winning trades get larger, and losing trades are kept small. The rule of thirds or quarters is flexible, but the core principle is rigid. Subsequent additions must be smaller than or equal to the prior additions, and the final addition should only occur at the point of confirmed breakout. For instance, a 20-30-50 split ensures that the commitment grows alongside the conviction provided by the market. The final 50% is the largest commitment because the market has provided the most evidence supporting the trade. This is the antithesis of the gambler's approach, which front-loads risk. Crucially, the price points for these additions must be strategic and separated, ensuring the average price of the full position is still favorable. Livermore never added capital close to the previous entry point. He waited for significant price separation, confirming momentum. This separation is vital because it ensures that the paper profit generated by the earlier tranches provides meaningful protection for the newly added capital. If the additions are too close, the entire position remains vulnerable to minor pullbacks. The discipline required to execute this scaling method is immense, demanding that the trader resist the urge to deploy the full 100% prematurely. It requires patience to watch a confirmed move run without having the full position size on, waiting for the optimal, safer entry points. However, this patience is the price of capital protection. Livermore understood that missing the first small portion of a move is acceptable if it means the majority of the capital is protected from the initial volatility. The phased approach to position sizing functions as an immediate and powerful capital protection mechanism. Since the vast majority of the risk capital, 75 to 80%, is deployed only after the trade is already showing a profit, the existing paper profit acts as a dynamic buffer against volatility. This buffer shields the underlying principal from minor market fluctuations and sudden, unexpected pullbacks. The strategy ensures that the largest capital commitment is inherently the safest. By the time the position reaches its full intended size, the trade is significantly in the money. This means that the theoretical risk exposure measured from the current price back to the initial stop loss is substantially covered by the unrealized gains. The trader is effectively using the market's capital to fund the majority of the exposure. This concept, trading with the market's money, is central to high-level risk management. It transforms the psychological burden of risk. When a trader is trading primarily with paper profits, the emotional pressure to exit prematurely or panic during drawdowns is significantly reduced. The trader knows that even if the market reverses sharply, the loss will first erase the gains, minimizing the impact on the core account equity. This financial cushion allows the trader to remain objective and hold the position through natural market volatility, maximizing the potential profit from the sustained trend. It is a psychological advantage built purely through disciplined capital deployment. Consider the practical mechanics. A trader enters the first 25% at $100. The price moves to $105 and the second 25% is added. The price moves to $110 and the final 50% is added. By the time the full 100% position is established, the average entry price might be around $106 or $107. If the initial stop loss was at $98, the trade is now $8 to $9 per share in the money. This buffer means the market can drop back significantly, perhaps to $102 before the trade even approaches break-even on the full position. This structural safety net directly addresses the video's core claim: how Livermore protected millions. He protected millions because his largest commitments were established only in confirmed profitable trends. This minimized the chance of a catastrophic loss originating from a sudden, sharp reversal at the full position size. The money that was put at risk early was always the smallest test portion, while the large capital followed only when the path forward was clear. The discipline of scaling ensures that a trader's largest risk is never taken on the unconfirmed entry. If the trade fails, it fails when the position is small, resulting in a minor cost of doing business. If the trade succeeds, the commitment grows alongside the market confirmation, ensuring maximum size is deployed for the maximum potential movement. This asymmetrical risk profile, small risk for timing errors, large size for confirmed moves, is the cornerstone of professional speculation. Furthermore, this method inherently manages volatility risk. Volatility is highest around the initial entry and major turning points. By using a small pilot position during this high volatility phase, Livermore minimized his exposure to whipsaws. By the time the full position was deployed, the market had often settled into a clearer trend, reducing the day-to-day volatility relative to the overall position size. This tactical reduction of risk exposure during periods of high uncertainty is paramount. The concept of letting profits run becomes significantly easier when the position is protected by substantial paper gains. Many traders prematurely exit winning positions because the volatility frightens them, especially when they have committed their full exposed capital. Livermore's method provides the confidence to withstand these pullbacks, because the trader understands the risk is primarily contained within the market's money, not their core capital. This allows for greater patience in capturing the meat of a major trend. This disciplined scaling is essentially a refinement of the stop-loss strategy. Instead of relying solely on a fixed price point below the entry, the risk management is integrated into the capital deployment itself. The initial stop-loss still exists, but the phased entry ensures that by the time the position is large, the stop-loss can often be moved up to the break-even point or even into profit, further securing the capital. The strategy demands that the trader constantly reassesses and locks in gains as the position grows. The failure to adopt this phased approach is why many traders experience the blow-up trade. They commit too much capital too soon, and when the market hesitates or reverses, they are left exposed with a large position facing maximum risk. Livermore's mastery was realizing that protecting the existing capital is always more important than maximizing the potential profit on an unconfirmed entry. His prudence allowed him to weather the inevitable market crashes and downturns that wiped out less disciplined speculators. The ultimate goal of Phase 3 is to ensure that the risk of ruin is minimized to the absolute lowest possible level. By only scaling into strength, the trader is constantly aligning their risk exposure with market probability. The market acts as the ultimate filter, allowing capital deployment only when conditions are optimal. This systematic reduction of exposure to unconfirmed ideas is the true secret to protecting a massive trading account over decades of market activity. Position sizing mastery, as practiced by Jesse Livermore, is ultimately the discipline of delayed gratification in capital commitment. It is a profound realization that the initial entry is the most dangerous moment, and full exposure must be earned through market confirmation. The secret rule dictates that position sizing is not merely about how much capital you allocate, but fundamentally about when you allocate it relative to the market's confirmation of your thesis. This strategic timing is the hallmark of professional trading. The entire methodology rests on the willingness to take a small, immediate loss on the pilot position. This small loss is the necessary cost of gathering timing information and is the highest form of capital protection. A trader who is unwilling to accept a minor loss on the initial probe is inevitably exposing themselves to a major loss on a full, unconfirmed position. Patience, therefore, is not just a virtue. It is the primary mechanism for preserving wealth. Livermore's success was not built on revolutionary indicators or unique access to information. It was built on rigorous discipline in capital deployment. He recognized that the market will always offer new opportunities, but capital, once lost, is difficult to recover. By scaling into strength and never averaging down, he ensured that his largest bets were backed by the strongest evidence, securing his fortunes against the inherent volatility of speculation. This systematic prudence is the true definition of trading mastery. The lesson for modern traders is clear. Stop front-loading your risk. Treat your initial entry as a test, not a commitment. Only when the market proves you right through sustained profit should you increase your exposure. This disciplined approach transforms position sizing from a bureaucratic risk calculation into a dynamic, strategic tool for maximizing gains while minimizing exposure to the most common trading errors. Follow the flow of the market, and let the market pay for your full commitment. If you are serious about mastering the psychological and strategic nuances of trading that defined Livermore's career, the foundational text is invaluable. We often talk about the strategies of legends, but understanding the mind behind the millions requires a deep dive into the source material. This new edition of Reminiscences of a Stock Operator offers exactly that, presenting Edwin Lefebvre's classic account of Jesse Livermore's psychology and strategies. It is more than just a historical narrative. It is a practical handbook, augmented with unique commentary and chapter-by-chapter breakdowns that translate Livermore's experiences into immediately applicable lessons for today's complex markets. To truly internalize the discipline of position sizing and capitalize on the wisdom of the past, you need this definitive guide in your library. Click the link in the description below to secure your copy and transform classic wisdom into modern trading mastery.